For builders slowing construction, and again, that's nationally, not locally, that means they're reducing supply. They're acting appropriately. They're reeling in supply so that inventories are contained and so that prices are stabilized. And in terms of the banks, well, if the banks, many of them were involved in making some loans that just didn't make sense over the last few years, making loans to people who probably shouldn't have been borrowing and using very risky vehicles to do so. You know, those profits were a phantom. Now they're having their own profit levels written down. So the people who are being hurt are the banks themselves in terms of their profit levels. This will not choke off the supply of money coming to the mortgage market. That is not a worry, because those investors, they're insurance companies, large 401ks, large funds, and they need a place to park that money for a steady long-term growth path. So they're always going to want to put it in mortgages. They're just going to avoid interest, you know, the risky subprime and the risky jumbo. So they're looking at that conforming market. Those, and the conforming is important because it's those under $417,000. That's how we define conforming. And those are the ones that can be backed by the federal government. So they view them as relatively riskless because they're backed. So all that money got funneled back in August into the conforming market, out of the jumbo, out of the subprime. And as a result, that's why we saw the dive in long-term mortgage rates from 6.8% down to 5.5%. Now, the Fed has been slashing rates. This is more important in terms of confidence and continuing growth and sustaining employment levels. But in terms of the other direction, in terms of mortgage rates, one more. What's been driving this is simply activity within the mortgage market. It's ironic that the subprime meltdown actually made conditions improve for those areas that weren't involved in the very sharp run-up in prices from 2000 through 2005. Because all those funds got funneled into the conforming market, we saw rates come down very sharply, and now monthly payments are coming down as a result. Another important sign, again, this is a trend outside of Syracuse. This isn't something that was abnormal. Again, in Washington, D.C., I couldn't use that FHA loan that I wanted to use. Now we're beginning to see very sharp increases in FHA usage. What this is saying is that sellers are finally working with buyers in the national market. More importantly, as we begin to get the national market off the ground, we'll get less of the negative media coverage of the national spillover into the local markets. Again, we're forecasting, this is how low it got. As a national percentage, FHA was only around 3.5% as of 2006. But if you look at what was going on in Syracuse, we were still right up around, bouncing around 20%. And that's important. That's what this is telling us again, is that we were very well anchored to the fundamentals. Buyers and sellers didn't get out of whack so that the sellers could really abuse buyers or vice versa. So retaining that FHA, very important for the stability of the market. To give an example, the alternative to FHA is the subprime market. It's what the private sector came up with as opposed to the government solution, to providing financing to those people with lower credit scores. Well, with an FHA loan, the average mortgage rate on a 30-year fix is between 6.25% and 6.5%. But for the subprime market, it's up around 9.5%. So not only is it much more expensive along the way, you aren't guaranteed an appraisal. And that's why sellers like to use subprimes or sell to people, buyers who are using subprime loans. It's because they didn't have to worry about appraisals and making improvements to the house. And so you'd have buyers who are completely strapped for cash, finding out a year down the line that they've got a crack in their foundation, or their roof's bad, or their water heater's done. So they've got all these hidden costs as well. So this is very important. It means this is the stability, long-term stability that was retained in the Syracuse market during this run-up in prices. There's a lot more reform that we're lobbying on that's going to help the market. This is that increase in the jumbo rates, the spread between the two, meaning basically the rate, average rate for somebody under 417,000 was about, say, 6%, for example. It surged to about 7%, 7.2% for somebody who was buying over 417,000. Again, that just chokes off affordability and sales altogether. So what's key, again, this is for the national perspective. Job growth, a shallow recession, continued cutback in construction, again, in those areas that are facing, that have already faced supply problems, very high supply. But what we're moving to is a true buyer's market, and buyers are beginning to really recognize that there are a lot of advantageous things going on, and they're finally realizing that there are many more concessions beyond just prices that they're getting. They're being able to use FHA loans again, which have much better rates. Appraisals are becoming the norm again, and so they're really taking advantage of those things. We're going to continue to see a little bit of Wall Street tightening, but we're weeding out the reckless lenders, and we're changing the psyche of buyers and sellers to a much more realistic long-term pattern. Again, this is all at the national level. So we're expecting, in terms of the national media, a lot more coverage of short-term pain, consternation, instability, giving away to long-term pain, stability, excuse me. Short-term pain, long-term gain. For our national outlook for, again, the national housing market, slight decrease from 2007 to 2008, but it's going to be loaded on the back end is where we're going to see an improvement. We're averaging, as I showed you much earlier, right around 5 million home sales at an annualized rate per month. So we're blowing them up. It's just a statistical term, so that looks like an annual. You can compare it at the annual level. We're going to have relatively flat for the first half of the year, right around a 5 million average, and then we're going to jump up to about 5.5 million. So much stronger back end to the year. Mortgage rates are going to remain low for the first half of the year and begin to tick up as the Fed takes some action. Short-term rates will begin to come down again, but not to a level that makes them advantageous versus long-term rates. And again, at the national level, we're expecting another moderate decrease in terms of prices. But this, again, is going to be a reflection of those high-price markets that are really taking it on the chin now in Florida, in California, and the high-price markets, New York City, and the like. What we're expecting in Syracuse, employment is going to be the key. But we've seen solid employment growth, so it's just a matter of holding on to what we already have. And it looks like we'll be able to do that. Construction has played its role perfectly. It's cut back, increased in the short run when it needed to, and cut back to reduce the supply, stabilize prices, and they got in ahead of time, so we don't have bulges in inventories like we see at the national level. Risky loan usage wasn't a problem. Remember, we didn't get to the point where you couldn't use an FHA loan, and we didn't get to the point where monthly payments were well above their historic average, well above the national average, so that people needed to use these risky arms just so that they could get in the door, hoping that they could refinance later. That was not the case here. Slow price growth yesterday means record affordability today. That's very important, that monthly payment at record lows or near record lows. And ironically, this is going to help us. The cleansing of the national market will get all those nasty, unscrupulous people out of the market so that you'll never have to deal with them. In terms of the financing, in terms of prices, you know, in many markets where there was overconstruction, so prices are falling and people can't refinance again, that's not an issue here. We don't have any of those fundamentals that aren't anchored well. FHA, VA usage, very strong. And again, this is just hinting that the local fundamentals are anchored very well. Cleansing of the national market, again, spells long-term health, not just nationally, but locally. We've got a lot of nice local programs, head home quarters. Some of these programs in terms of the down payment assistance and price insurance, they help in case there's a slowdown in prices. They insure you against that. So it helps to create stability so that there isn't ever a run in terms of everybody wanting to sell at one time or everybody wanting to buy at one time. So it helps reinforce the local stability. And then finally, if you combine the two, record low conforming rates with very strong affordability, it just reinforces that point that we should have long-term, steady, stable growth. So it's the case of slow and steady really won the race here in Syracuse. So with that, I've concluded my presentation, but I think we'll save the questions for later. Is that correct?